The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A surprise on CPI, a blow from IBM, and scrutiny of the big U.S. banks. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. And take a look at this setup right now. It's the exact opposite of yesterday when we were down and it was big tech leading us. Today, you have the S&P 500 higher by about 0.4%. A lot of that strength coming through in the NASDAQ 100, higher by about 1.2%. A lot of action once again when it comes to the bond market. This time to the downside when it comes to yields. I have that 2-year Treasury yield up right now, down by 9 basis points after that pleasant surprise on CPI. We were down about 14 basis points earlier in the day, but still a big rally. And of course, keeping an eye on Brent, rising once again, trading around $85 a barrel as we watch developments in the Middle East.
Absolutely, and that bump in equity prices, that drop in yields initiated this morning by the latest consumer price numbers, while core CPI still above the Fed's 2% target for 5 years and running now. The monthly gauge did actually decline year over year for the first time in 2026. Now that takes some pressure off the Fed and off Kevin Warsh, who was peppered with questions by Congress on how committed he would be to the inflation fight.
If we get policy right, and I can assure you we will, the inflation surge of the last 5 years will be a thing of the past. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to ensure price stability.
Of course, holding the line means making sure the inflationary effects of AI don't actually spread too far and wide. IBM CEO Arvind Krishna jolting investors earlier today by saying several of his customers are actually holding back on software spending because they're being forced to shift more capital to increasingly expensive servers, storage, and memory. Now, IBM's profit warning aside, the big banks provided a decent start to the earnings season. 4 of Citi's 5 units surpassed analyst estimates. Goldman posted a third straight quarter of record stock trading. Bank of America, it telegraphed better operating leverage than previously projected. And JPMorgan reported its highest quarterly profit ever. But the results came with a jump in costs and a warning from Jamie Dimon of risk shifting below the surface like tectonic plates, including inflation, fiscal deficits, and elevated asset prices.
Well, let's also talk a little bit about Wells Fargo, one of the big banks reporting today. Taking a look at their shares, actually down slightly today, even though when you take a look at non-interest income, a big recovery there. We've been following that story. That measure hitting $10.3 billion in the most recent quarter reported. That is a 4-year high. It's ahead of analysts' expectations, but not giving much of a lift to the stock today because the focus really seems to be around margin, that NIM measure, which is coming under some pressure, Romaine.
All right, well, let's talk about that pressure. Mike Santomassimo joins us right now, the CFO over at Wells Fargo. And obviously on the surface, Mike, obviously a lot of progress in the quarter, a lot of progress over the last couple of years. But when we talk about average loan growth growing in that 12% range year over year, but net interest income only up 5%. I know you've said in the past that this is temporary, but how long should investors expect that disparity?
Well, thanks for having me, Romaine. And you know, when you look at like the backdrop of the quarter, it was actually a really good quarter and broad-based revenue growth across every single business. And you know, we can sort of dig into aspects of it, but really good performance across every one of them. And on net interest income, you know, it's progressing exactly as we thought it would, right? So our full year net interest income, you know, guidance is still $50 billion. That's where we set at the beginning of the year. You're seeing, you know, loan growth be a little bit higher than what, you know, we had projected in the year. We're also seeing higher interest-bearing deposit growth, which is actually a good thing for the long run. So we're deepening, you know, our client relationships in the commercial side of the house in particular. We're expecting, you know, non-interest-bearing deposits to be more stable, and we were thinking they would grow a little bit more earlier in the year. And, you know, part of that's the rate environment as rates stay a little bit higher for longer. And so we'll see how that progresses. And then we're seeing really good growth across the markets business where you see, you know, NII contributions coming through a lot of the financing we do there. So overall, actually quite good. You did see net interest margin decline as expected, 3 or 4 basis points this quarter. We expect that to happen just a little bit more in the third quarter, then stabilize from there. But all of the underlying inputs and trends that we're seeing across the business are actually quite good, and really what we expected to see, now that we're about a year off of coming out of the asset cap.
Well, let's talk a little bit about that, because that's obviously opened up a lot of growth opportunities for you beyond just the basic loan book here. Let's talk about the wealth management side of this business, the growth there, but also the expenses that come along with it in order to build it out.
Yeah, look, the wealth business, as we've talked about a number of times, is actually seeing really good momentum now. If you go back a number of years, we were seeing high levels of attrition of advisors. That's completely turned around. We've had, our 3 best quarters, maybe ever, in terms of recruiting that we've put onto the platform the last 3 quarters. We are seeing net flows as well the last couple quarters, just broadly across that business. And the markets have really helped in terms of equity values. And so you see, wealth management revenues up in, 13, 14%, year on year. And so quite good there, in terms of the overall, trends underneath that business. Now that does bring expenses too, right? So you got commissions you pay advisors, and other volume-based fees that are there, but revenue more than offsets that. And that's what you saw in the quarter, which was really good performance. And then lastly on wealth is you're starting to see really good growth in deposits and lending as well. We've talked about that for a while as something we want to do to broaden what we do with our clients, and you're really starting to see that come through the results. And so a lot of the effort the team's had there the last couple of years is really coming through.
And Mike, I want to talk a little bit about M&A when it comes to Wells Fargo, because you think about that asset cap that has now been removed from the Fed. How big would you say that M&A is for you at this moment?
Yeah, we're mostly focused, Katie, on organic growth. I think the opportunity we have across each one of the businesses is just, big, to grow organically. And that's what you've seen us really do now the last number of quarters. And I think, when you think about, opportunities for M&A, there could be some, product capabilities or other, payments related stuff that could be interesting. But it would be very much just adding capabilities to what we do. Our main focus is really growing sort of organically across each of the businesses.
Understood there with the focus on organic growth. But I do want to talk a little bit about the pipeline, because you did say when it comes to the M&A pipeline for Wells Fargo, it looks robust here. And I'd love to dig into that a little bit more. Are there any industries which particularly stand out to Wells Fargo at this moment, or that you're, pursuing more aggressively than others?
Well, across the investment banking space, we've been adding, people in equity and debt capital markets, our M&A practice, and all the coverage groups, just sector by sector over the last, few years. And the pipelines are quite healthy, now, and they've been that way for a while across really all the product set there, including M&A. And you're certainly seeing, across a number of different industries, sort of, deals that may not have been, totally possible, a couple of years ago. And so I think that idea of pursuing those strategic goals across really, in a pretty broad way is definitely alive. And the conversations the team's having, it really spans everything from healthcare to tech to media to, a whole different, all industrial sectors as well. And so I think you're seeing it in a pretty broad-based way. Now, we'll have to see what actually happens in terms of deals getting announced and done, but I think the activity level is quite high, and I think people see this as an opportunity to think broadly about their strategic goals, and M&A is definitely part of it.
Well, overall, I mean, just looking at this business, a year kind of post that asset cap being lifted, with loan growth going well, obviously the M&A business and fees there also strong here. Is there a certain part of this business right now that you and Charlie Sharp, the CEO, are really looking to, where maybe you don't think Wells Fargo, at least right now, punches up to the weight of its competitors?
Well, I think there's opportunity to grow and improve the returns everywhere still. That doesn't take away from the progress we've made, because we've made a lot of progress. In our corporate investment bank, you've seen that progress in our investment banking business. We had a record fee quarter for investment banking fees this quarter across the firm. We've grown our balance sheet in the markets business by almost $200 billion since the end of 2024, and you're seeing the revenue in that business grow 24% in the quarter. You've seen our wealth management business, as we talked about a minute ago, grow. Our commercial bank was up 6% in the quarter, year on year. Our consumer businesses were up. We saw really good growth in credit card acquisition, in auto loans, really across the board. And so I think we're excited to kind of see, the results of all the investments we've been making now for a while across each one of the businesses. And I think each of them have a lot of opportunity to continue to deepen deepen what we do with a lot of the relationships we have, and really grow beyond that over the coming quarters and years. So it is an exciting time to be here.
And Mike, just quickly before we let you go, I do want to talk a little bit about AI, because we heard from JPMorgan's CFO actually talking about how the bank is being a little bit more strategic when it comes to using some of these AI models. He said exactly that you really don't need the latest cutting edge, incredibly expensive model to summarize an analyst report. And I wonder, how you're thinking through some of these token expenses and AI costs when it comes to Wells Fargo.
Yeah, that just comes with any investment, I think, really, is being smart about sort of how you deploy the capabilities. And AI is no different, right? There's a wide range of models, capabilities, use cases, for AI. And I think it's just, you need to be really thoughtful, smart, focused on sort of using the right solution for the right problem. And we're certainly doing that. And I think you need to look at, token cost and sort of the cost of broader AI sort of, very closely. But it's clear that the benefit you're going to get from AI in terms of improving what we do for customers, driving more efficiency across the firm, is real. And it really has just getting started in terms of those capabilities being rolled out across different business groups. And so I think it's going to be very exciting to see that come to fruition over the next 12 or 18 months or thereabouts. And so I do think it's going to be quite significant in terms of the impact it'll have, just more broadly at our company and just lots of different companies there. But like any investment, you got to be really thoughtful and smart about how you prioritize the resources you put against it. And certainly across these different large language models, there's a range of outcomes and a range of cost that you got to be really careful about as you look forward. And I think our teams have done a really, really good job on that, making sure that our tech people are using the right tools for the right solutions, and then just broadly across the businesses doing the same thing. So that's something we've been doing for a while now.
All right, Mike, always a pleasure. Always appreciate you taking time for us. Wells Fargo CFO Mike Santomassimo there. And don't miss our conversation next week with the CEO of Wells Fargo, Charlie Scharf. He'll be joining The Close next Wednesday right here on Bloomberg TV. Meanwhile, here on this Tuesday afternoon, we're going to catch up with the CEO of Strategy, Phong. He'll be joining to discuss the recent crypto swings and, well, what lies ahead for the company's financial position. That conversation coming up in a second right here on Bloomberg. We continue our analysis of the earnings of 5 of the 6 biggest banks here in the U.S., including JPMorgan, Bank of America, and Citigroup. Joining us right now to discuss is David Chiaverini, equity research analyst over at Jefferies. And David, I do want to start with Citigroup, as it seems to be having the worst day amongst the bunch. And it seems to be tied to this idea of costs, expenses, related to what's going on internally. And I am curious if there was any sort of concern about what Jane Fraser and the other folks were talking about with regards to those expenses, despite what was otherwise a record quarter.
Yeah, you nailed it. It was a very strong quarter overall, but it's really the outlook that caught investors by surprise. And it relates to the expense outlook and what's embedded in their ROTCE outlook. So they reiterated the 10 to 11% ROTCE for this year. But the first half of this year was 13%. So when you do the math, it equates to, 8 to 9% in the second half, whereas investors were thinking that it could be, potentially raise that guide for the year. And what they attributed it to was $5 billion of investment spending that could be pulled forward into 2026 from 2027 and 2028. So it relates to the card business, marketing spend, AI, talent acquisition, so really across multiple businesses, but it's really that $5 billion that's catching people off guard.
And David, it's interesting because when it comes to higher costs, it's not just a Citi story. We also heard from JPMorgan talking about higher compensation costs. We heard from Goldman Sachs as well, talking about how operating expenses were up 26% from a year earlier. So I wonder, zooming out, what you make of that, the fact that across the board, it seems like these costs are going higher.
Yeah, so the nice thing about, for instance, you mentioned JPMorgan, they had $4 billion of revenue upside in the quarter. So when they raised their expense outlook by $2.5 billion, it's more than offset on the revenue side. So I'm not as concerned about seeing expenses go up when it's revenue-driven type of expense growth. But when you have investments that you weren't necessarily expecting in the model that are now coming through, that's what's catching us off guard related to Citi. Now, long term, we think that they will be on track of hitting their medium-term outlook, getting to 11 to 13% over the next couple of years, then 14 to 15% looking out a couple of years thereafter. JPMorgan, on the other hand, they are over-earning on their ROTCE. They're up at 29% when you include some non-recurring items, but even in the low 20s when you adjust for those, and that's well above their kind of through the cycle guide of 17%. So they are in a position of strength to put forth all of these extra investments on the expense side.
I do have to get your thoughts on Bank of America. A similar story with obviously a little bit of a different complexion here. But when we talk about these companies being boosted not only by trading revenue, but obviously the capital markets business, is this something that's repeatable? I'm specifically asking about whatever the heck Brian Moynihan's doing there over at Bank of America.
Yes, so Bank of America, they had the cleanest quarter of the big four, and the capital market side of things really is a nice contributor to that. Year over year, they were up in the 30-40% type of year-over-year growth. So really strong there. But what really I think is resonating with investors for BofA is on the NII side and the durability of their NII outlook. So even though they reiterated the upper end of the 6 to 8% NII guide looking out, they're calling for 5 to 7% over multiple years. And then to your earlier point about expenses, positive operating leverage for BofA. They previously were guiding to greater than 200 basis points. They now raised that to 300 to 400 basis points of positive operating leverage. And this quarter in particular was over 600 basis points of positive operating leverage. So they really are getting the torque in the business as they see that NII move forward.
All right, David, really appreciate your time on what I know is a busy day. That is David Chiaverini. He's an equity research analyst over at Jefferies. Now, coming up, small business optimism climbing by the most in over a year. NFIB Research Center Executive Director Holly Wade joins us live to break it down. This is The Close on Bloomberg. The NFIB's Small Business Optimism Index rising by the most in more than a year, fueled by some relief in oil prices. Joining us live is Holly Wade. She is Executive Director of the NFIB Research Center. Holly, great to have you with us. So from May to June, you saw the index rise by 2.1 points, I believe. So talk to us a little bit about what changed for these small business owners. Is it as simple as oil prices?
It does seem to be a heavy contributor to the rise in optimism. Small business owners see the next 6 months of business conditions more favorably, and also sales expectations. So they might be thinking that consumers have a bit more discretionary income, or even business to businesses, having some more money in their pocket to spend. And so there aren't those constraints that they previously feared as far as, the dealing with gas prices and fuel prices, just energy prices in general. That's been such a challenge for many of them. But on the flip side, from our index, while we saw expectations for sales improve, better business conditions improve, we did see some deterioration in earning trends. And so while small business owners are having to absorb those higher costs, inflation is still a problem on Main Street for many of them. The disconnect between having to absorb those higher prices and pass along those costs to customers, that's eroding a lot of small business owners' earnings, and that's a challenge that they're having to still deal with.
So is the sense here, Holly, that they don't necessarily have the pricing power to be able to raise those prices to absorb those costs? And if so, and if that is the case, are we potentially in a situation where they are going to see a loss of customers as they get frustrated with where things are?
So that's certainly the challenge that they face, and the concern that they're dealing with is how often and how much can they absorb those costs through higher prices and still be competitive. While they did have a bit of reprieve from higher gasoline fuel costs over the last month, that's reversed. So if, the higher optimism index is basically all predicated on lower fuel costs, we might see this as just a temporary kind of boost in optimism as we've seen gas prices start to inch higher over the last few days. And so, small business owners, uncertainty is still a problem that they're facing, and trying to figure out how to stay competitive in this environment of still fairly high inflation that they're having to absorb.
And let's talk a little bit about labor costs as well, because it feels like we've been in this low fire environment for a while now. How is this playing out at the small business level when, again, you think about those labor costs?
Well, we're seeing the same dynamics in the small business sector. For a lot of small business owners, they still have open positions that they're trying to fill, and it's still very difficult to find applicants that have those skills that they're looking for. But for others, they're on pause. They have less money to invest in their business, whether it's, capital investments, whether it's filling positions, hiring more people. They're holding on to those dollars because of those inflation pressures. And also on the compensation front, we've seen compensation pressures ease a bit, but still, small business owners are having to compete for talent. And if they're offering benefits, for instance, health insurance, those costs continue to go up also. Yeah. And so, they're hit by a lot of different fronts on the cost and increase in input costs for their business, and that's a challenge for them.
Holly Wade, Executive Director for the NFIB Research Center, as we continue to count you down to those closing bells. When we come back, we're going to talk about strategy, boosting its cash reserves, but refraining from buying or selling Bitcoin. A shift in strategy, a conversation with the CEO of strategy, Phong Lee, after the break. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're keeping an eye on equities, but let's check in on the world of digital currencies. Strategy beefing up its reserves to $3 billion following its recent stock sale, not buying or selling any Bitcoin between July 6th and July 12th. Joining us live, I'm pleased to say, is Strategy CEO Phong Lee. Phong, fantastic to have you with us. So as I said, this week, you issued that stock sale. Your cash reserves are up at $3 billion. My understanding is that this allows you to pause Bitcoin sales for the time being. But talk us through, what the next several months look like. Do you plan to sell more Bitcoin? And if so, how much?
Katie, thanks for having me. We have really evolved from being a Bitcoin treasury company to a full digital capital platform. We're the world's largest identified holder of Bitcoin in the world. We have over 840,000 Bitcoin. Digital credit has been launched in the last year in the form of Stretch. That's $10.5 billion. So we have a responsibility to our common shareholders, our preferred shareholders, and to Bitcoin, of course. We issued we've accumulated $3 billion in cash because we listened to our preferred shareholders, and they said having liquid cash on our balance sheet in the short term is important. And we also sold Bitcoin to be able to show liquidity with our Bitcoin. Yes, we will continue to issue capital. It could be in the form of MSTR, it could be in the form of Bitcoin, and we're going to make the decisions that are best for our shareholders over time.
Well, could it also potentially be in the form of STRC? That, of course, are preferred shares. They're known as Stretch. My understanding is that you last issued Stretch in mid-May. Of course, it's been trading at a discount here. Do you plan to issue Stretch again in the near future?
Yeah, our plan is to get Stretch back to par. Unsure how long that will take. Building up the U.S. dollar reserve was a big part of that, and we'll continue to build that. And yeah, when Stretch gets back to par, we'll issue more. we'll buy Bitcoin. We may continue to beef up our US dollar reserve. That's a big part of our capital plan, is to issue more preferred over time, because it's very accretive to our Bitcoin per share, which is accretive to our shareholders.
Well, I am curious just about just kind of the structure going forward. I mean, to get back to par, is there a sense here that you can do that, whether it's with selling more Bitcoin or issuing more equity? Have you determined what might actually be the best path to get there, or the most efficient path to get there?
We think the first thing is the U.S. dollar reserve, right? I think we've learned over the course of the last couple of months that having that liquid access to U.S. dollar capital, whether it be 1, 2, 3 years, is quite important. And we saw when we increased it in the last couple of weeks, we got stretched up from a low in the 75 range to close to 90. So we'll continue to build that. We increased the dividend. I don't think the dividend is as much of a factor. And I think a track record of success and a track record of execution. And then, of course, education. We're a year into the product. A lot of financial products take 2 or 3 years to mature. So we're early, we're learning, we're listening to the market. And the great thing is there are built-in mechanisms with a market, for example, going to par, right, and staying at par. That's a mechanism that lets us know what we're doing right and what we're not doing right and what we can improve upon.
What's the communication, though, with shareholders overall? There's been a lot more focus, obviously, on the preferred shares. But, I mean, you guys issued a ton of common equity in the preceding years. And I am curious if there's any sense in trying to reconcile with some of those folks who bought a lot higher than where that 96.73 price stands right now.
Our shareholders understand our primary goal is over time to outperform Bitcoin, which is an extremely volatile asset, right? It's vol is somewhere in the 30, 40, 50 range. And they understand that MSTR is built to outperform Bitcoin. And as a result, when Bitcoin goes up, MSTR typically goes up more. When Bitcoin goes through a bear cycle like it is right now, MSTR can perform a little bit worse. But as long as MSTR is priced at greater than the net asset value of our Bitcoin, it means that our shareholders are giving us credit for the performance above Bitcoin. And when we do that, we can issue more equity for the most part. Look, we talk to our shareholders all the time. There's quite a few constituents, as you know. We're one of the most liquid stocks in the world. And when we talk to our shareholders, institutional, retail, we look at what people say on social media. We take a lot of comments. We bring that all in, and it's great to have the feedback.
And I mean, just looking forward, again, I mentioned that, you know, your cash reserves, they're $3 billion right now. It seems like you have several years of being able to cover your interest expenses. But I mean, when you game plan out in the future, 3 years, 5 years, it just feels like Bitcoin has been stuck in this rut for a while now, you know, trading around $60,000 per coin or thereabouts. But do you have a break glass sort of plan if, you know, we go down to 30,000 or 20,000 or even below?
Yeah, when Bitcoin gets down closer to 8,000 to 10,000 is when we're going to have, you know, we have to consider some of the risk associated with our debt. Until that point in time, we feel very secure about the balance sheet. Look, to your point, Bitcoin has quite a bit of volatility. It goes up and down, and every time it's in a bear cycle like it is, people ask, okay, will it go to zero? And it hasn't yet in its 18-year history. In fact, it just achieves all-time highs. But what we need to do is build a capital structure that can withstand bear markets and, of course, benefit from bull cycles. And that's what we've done so far. We've been through this in 2022. We're going through it in 2026. And I'm pretty excited about the next bull market of Bitcoin.
So for those folks who are concerned that sort of strategy as being kind of the dominant buyer, or at least a perpetual buyer of Bitcoin, there's some reassurance you can give them that you are not gone from that market as a buyer?
We're not going anywhere. We're the largest identified holder of Bitcoin. My objective would be the largest buyer of Bitcoin for the foreseeable future. We're not going anywhere. Anybody that's worried about strategy shouldn't be. That said, Bitcoin's a lot bigger than us, right? We are 4% holder of Bitcoin. Bitcoin trades $30 to $40 billion a day. You saw a couple weeks ago, we sold about $200 million of Bitcoin. It did not move the market. In fact, the market moved up during that period of time. So, but we're not going anywhere. We're sticking with Bitcoin for the long term. We'll be buyers of Bitcoin for the long term.
Okay, so you're not going anywhere. I do want to go back a little bit to the preferred shares because Bloomberg News did report last week that distressed funds, they're in talks to swap their preferred shares for other securities. Of course, that would be a negotiation. And with that in mind, can you give us an update on what those conversations sound like? What is actually developing there?
Yeah, there may be funds talking to each other about swaps. We haven't been in any material conversations. The way we're going to make Stretch work is we're going to continue to increase the U.S. dollar reserve. We're going to listen to the market. We've put out, the opportunity and the option to buy back Stretch if it makes sense, but we're not in any material conversations otherwise.
And Phong, before we let you go, I want to reflect on strategy a little bit because you're the CEO of strategy. You're best known, of course, for being a Bitcoin treasury company, really the OG. But you also have a software business. And as of the end of March, you had more than 1,500 employees. And I'm wondering, sitting in the CEO chair, how much of your time do you divide between this ecosystem of financing that you've built up to accumulate more Bitcoin and the actual underlying software business?
I'll start with I'm an engineer by education. I'm a technologist at heart. I'm a financier as my day job, I'll call it. So I love software. I love AI. I love Bitcoin. They're the convergence of all the things that I've really enjoyed doing. 50-50, 40-60, a lot of the discipline is the same. And keep in mind that the 1,500 employees, we have folks who are in finance and marketing, in engineering, in legal and accounting that are able to bring a maturity and 25 years of public company experience to our Bitcoin business that I think a lot of other companies that are in the Bitcoin or DeFi world aren't able to bring. And it's part of, I think, what makes us successful.
All right, Phong, really appreciate you taking time for us. Phong Lee there, the CEO over at Strategy. We do want to bring you some quick breaking news. This from the U.S. military confirming that it has begun yet another day of military strikes against Iranian targets. Apparently that started at 3 p.m. Eastern time. CENTCOM is also reiterating that the blockade that the president had announced that would go into effect today will indeed go into effect at the top of the hour. We'll keep an eye on that, and we'll keep an eye on the price of oil as we count you down to the closing bells with most of the major indices still in the green. This is The Close on Bloomberg. Time now for our stock of the hour. IBM down more than 20%, its biggest one-day drop in 58 years. The company's CEO warning that it's actually lost out on closing some deals because some of its customers, they're actually pulling back on some of their software spending. Anurag Rana over at Bloomberg Intelligence, he joins us right now to talk a little bit more about what's going on. Anurag, a bit of a surprise, certainly to markets here, but overall, we've been talking a lot on this network about how much companies have been having to spend on servers and memory chips and other things like that. I guess we're now learning, at least for IBM, that's at the expense of software. Is this an IBM problem or software across the board?
I think not just software, but software and consulting problem across the board because, what's happening is with memory prices going up, if you are a big company, you're thinking, do I buy my servers today or tomorrow when they're going to get more expensive? I mean, I think you could, perhaps extend that same argument to the phones because right now iPhones have not gone up, but you will expect them to go up over the next couple of months. So that's what's happening. You're pulling forward the buying of hardware, but it's going to come at the expense of something else. And that's what we saw in this quarter for IBM. And I think that's going to be a recurring theme when more other software vendors announce results over the next 30 to 60 days is people are pulling back on some of the places where they can cut back.
Yeah, and certainly you're seeing that same reaction work through the stocks of ServiceNow, of Workday, for example. So, Anurag, that pull forward that we're seeing among tech companies, I mean, is there anything for IBM and its peers to do other than wait it out, given that, they don't have any ability to bring down the cost of servers or chips?
Yeah, but in the case of IBM, for example, the CEO mentioned a particular software division called transaction processing. When you buy a mainframe, you have to buy this software along with it. Not just along, it usually takes a few quarters because you buy the product and then you installing it after that, you're going to upgrade the software. you're going to not be able to use the product unless you buy the software. So it gets pushed off in the next quarter or perhaps the quarter after that. But eventually it comes back. So it's not that this is revenue lost. It just gets extended into another quarter. But what we don't know is how long the Iran-US situation is going to last. We do not know when memory prices are going to stabilize and start to come down. So with all these things, it's very difficult for a leader, not just for an IBM, but anybody else to figure out when do I actually go out and raise my guidance.
Well, IBM shares down 25%. Anurag, really appreciate the breakdown. That is Anurag Rana of Bloomberg Intelligence. Coming up next, it's the closing bells. We're going to take you there with Lori Calvasina. She is head of U.S. equity strategy over at RBC. This is The Close on Bloomberg.
Welcome back to The Close. I'm Romain Bostic.
And I'm Katie Greifeld, keeping an eye on that rally as we head into the close. The S&P 500 higher on the day. A lot of strength coming through when it comes to big tech. And it's really interesting that it feels like it's big tech that's been leading the market to the upside and to the downside. That has been the dynamic of the past few weeks, Romain.
But it is also kind of this, I guess, this swivel, if you will. I mean, we have this big plunge, particularly when it comes to some of the chip stocks, and then the next day, everyone comes in and buys that dip, and then they get scared of something else, and they scurry back in for a day or two, rinse and repeat.
Yeah, it's like a case study in psychology, and it is also, the dead of summer, so maybe that's also contributing to things.
All right, as we count you down to the closing bells, let's get some insights out of Lori Calvasina, head of U.S. equity strategy over at RBC Capital Markets. And Lori, I do want to start on tech. You're relatively optimistic about tech going forward. You've gone to overweight. Is that all tech? Are we talking chips, software, everything in between, or is it just a pocket of tech?
Yeah, so we only make recommendations on the broader sector. I try to leave that to my analysts, the industry calls. But I will say in the latest analyst survey that we did, and we do this once a quarter, we did see, kind of bullishness from the U.S. tech analysts. Now, we saw that for a number of other sectors as well, but one we didn't really see it for was the communication services sector, which also has a lot of tech within it. So just on the basis of the fundamental bottom-up view, the signal I was getting from my analysts was to fade communication services, which had previously been sort of my favorite growth-oriented sector, and to move back over into tech. The other thing that we've noticed, you do frankly have better valuations in the communication services sector, but when we looked at tech, we've actually seen it's improved basically back to neutral, just given some of the carnage that we've seen. And you have seen a bit of an unwind in semi-valuations, which had gotten pretty expensive. They're not super cheap yet. They may still have more to go. I want to be clear about that. But we have done enough improvement there to allow the sector, kind of froth to come out.
Well, speaking of valuations, it looked like valuations are starting to get somewhat attractive in the software space. It's certainly if you believe in the long-term story of these companies. But we got a little bit of a jolt today with the comments out of IBM CEO, seemingly this idea that people are diverting cash to hardware and other things rather than to software and consulting services. Are you worried about that sector at all?
Well, it's interesting. If you look at the software space in and of itself, people always ask me, have tech valuations or semi-valuations gotten back to tech bubble peaks? I'm like, well, actually, no. But if you go back and you look at the software space, it did that back around COVID. If you look at the Russell 3000 software group on a median PE. And we've been seeing a compression in that PE multiple ever since. I have a fascinating chart. We talk about this in almost every meeting. And those valuations are basically, kind of hovering around financial crisis lows. Now, when I talk to investors, I will say prior to today, I wouldn't say people were warming up, that's too extreme, but maybe the tone had improved a little bit at the margin. But generally, we've been showing people that software valuation chart, and, as one person put it to me maybe about a month ago, maybe we'll, look back in 3 and 5 years and say we should have bought this space, but we need a reason. And I've frankly had some clients say, I want to see the performance improve first. Around the Russell reconstitution, there was some chatter about software weights going up. Normally that's the kind of thing, right, that, will get a lot of people excited about kind of buying a deep value group. I didn't see any biters on that.
So we're talking about software. We're talking about your upgrade of the tech sector. I want to talk about the other side, because you recently downgraded utilities to underweight. You write that industrials was also a candidate for a downgrade, and that's interesting because those are two sectors that you've seen some of that AI halo effect, the build out extend to those sectors. But is that story, has it run its course?
So if you look at my sector valuation model, right, and it's very simple, basically like a Z-score on a median PE for the S&P sector's point-in-time constituents going back to 1989. And if you're in the red on the grid and far right on the grid, you're expensive on both an absolute and relative PE. So versus its own history and then taking a ratio versus the broad market and versus that history. Guess what sector is the most extreme in the right of the grid? It's industrials. Guess what's pretty darn close to it? It's utilities. And it's not tech anymore. You know, it's not consumer discretionary, another sector we upgraded. And we're concerned about that valuation issue, frankly, because if I look back over the course of the last year, this market does not tolerate valuation froth for very long.
Right.
So if you look at the top 10 market cap names in the S&P 500, kind of the harbinger of the mega cap growth trade, anytime we get above 30 times, we fall and we wobble. And guess what? We hit 31 times recently, but we've also done it a couple times in the past year, and that's when that trade tends to unwind and we have this big broadening move. In January, February, metals and mining got expensive. We saw that, remember when gold prices went down and geopolitics were flaring up and everyone was confused why? We had gotten a stupidly overvalued situation on that group on my valuation work. If you looked at the capital markets group, when all the private market fears percolated, that group, which has the investment banks, the alt asset managers, that had gotten ridiculously overvalued.
Right.
And that's when all those fears came in. So now people are like, what's next? I'm like, well, we just shot semis, you know, and it's not completely, you know, down and out yet on the valuations, but it had started to go parabolic and the market was like, no, 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 you're going down.
Right.
And so what's left? Utilities and industrials. Now, industrials, you got strong fundamentals. Utilities, we go back to that analyst survey last week. My analyst was neutral. And if you're neutral when most everybody else is positive, that puts you at the bottom of the pile.
Well, that's what I was going to ask. You know, what made industrials escape, even though they're both flashing red on that very compelling picture that you paint?
And so I would say it was stronger endorsement from my analysts. So I asked them to rate their industry outlook, and we aggregated up by the sector. So, you know, that sense of fundamentals was strong. And frankly, I hear that from clients. And sometimes when I bring up this valuation issue, I get very emotional pushback on that. Now, I am not one to sort of go with what everybody says. Anybody who knows me, I'm not afraid to buck the trend. But we go and look at our earnings revision indicators. So one of the tiebreakers here was that if you look at industrial, the rate of upward revisions on both sales and earnings, very, very strong. So I understand why people say maybe the E is too low. We've had all this stimulus, you know, kind of supporting that E. There's a lot of, you know, kind of clarity. It might go higher.
Yeah.
If I look at utilities, it's got upward revisions, but it's weak. It's much weaker than other sectors, and most are in positive territory.
We only have about 30 seconds. I do want to get your thoughts on the earnings season, particularly when it comes to consumer discretionary stocks. Is that an economic story? Is that a valuation story? Are you hopeful?
So with consumer discretionary, you know, we looked at the University of Michigan survey last month, which inflected across the board on almost every, you know, data point. And equities respond to rate of change, not level. And, you know, especially when you're kind of coming off bottoms. I've been getting some pushback on our underweight there. Valuations had improved to neutral. We've seen specialty retail move into the green on my industry grid, which means valuations look good and you've got positive revisions. We didn't go to overweight, but we felt like it wasn't somewhere we wanted to be underexposed anymore.
Lori, always a pleasure. Lori Calvasina, one of the best in the business, head of U.S. equity strategy over at RBC Capital Markets, counting us down to the closing bells here, Katie. The S&P up about 0.5% on the day. The NASDAQ, as expected, out front with that big bump in some of the tech stocks.
Yeah, not exactly green on the week yet. It's only Tuesday. You think about that drawdown that we saw yesterday, 0.8%. Not quite out of that hole yet, but certainly some progress. All
right, we are counting you down to the closing bells here on this Tuesday afternoon. The S&P in the green, the equal weight in the red. Our global simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Masser and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television and radio, our partnership with YouTube, a rebound from yesterday here with a big bump from NVIDIA, Apple, quite a few others, but a big drag down by IBM, Microsoft, and some of the software companies.
Yeah, absolutely. The churn a little bit among some of those well-known names. Having said that, you know, you're still seeing some outperformance when it comes to tech names. You've got, what, the NASDAQ 100, Tim, right now up about 1.2%.
Yeah, I think people still concerned about what's happening out of the Strait of Hormuz. I mean, Katie, it's leading to higher oil prices. Just in the last half hour, we heard that the U.S. military says it started more Iran strikes today. That was at 3 p.m. Eastern time. Once again, we're seeing oil prices higher.
Yeah, absolutely. You take a look at Brent trading around $85 a barrel here, and it does kind of make the case that maybe the inflation figures that we got this morning that are leading to a bump when it comes to the equity market, that drop down in yields, maybe that already looks stale when you think about what we're seeing on the geopolitical front, but still certainly fueling quite a rally in the bond market.
And we talk about that rally in the bond market, pushing yields on the 2-year down about 10 basis points, if you can believe it here. So a lot of people not buying into the idea, at least today here, that the Fed is going to hike rates anytime soon. I don't know if this ends up being a Goldilocks situation for Kevin Warsh, who we saw on the Hill earlier today. He can be as hawkish as he wants in terms of his commentary, but as far as moving rates right now, it does look like they're going to be pinned where they are for a while. We get the closing bells here in New York. Green across the screen for all of the major U.S. indices. The Dow Jones Industrial Average, that's your relative laggard on the day, only up about 30 points or just a little bit less than 0.1%. The S&P 500 is going to add about 29 points or 0.4%. The NASDAQ Composite up 0.9%. The NASDAQ 100 up 1.1%. And the Russell 2000, Carol, adding about 12 points or 0.4%.
All right, you finished with small caps. I'm going to go back to the big cap names, the S&P 500. 204 names in the S&P 500 higher today, Katie, 296 to the downside, and you've got about 3 unchanged.
You take a look at the circle, which measures our sector performance. You have 6 sectors in the green, and it's information technology leading the way. Look at that bright green slice, higher by about 1.3%. Also a good day for communication services, higher by about 1.1%. In terms of what didn't perform today, it's pretty interesting. Healthcare down about 1.9% as a sector. That is your biggest drop to the downside. Consumer staples also off by about 1.4%, Carol.
All right, guys, let's get to some of the individual gainers. I'm going to start with a bunch of the financial names because we definitely saw, 5 big banks reporting earnings, 3 of them rallying in today's session. Let's take a look at JPMorgan. It was up 2.5%. Goldman Sachs soaring today, up 9%. BofA also moving to the upside, just shy of 2% here at the close. I mean, Wall Street traders coming out on top as the biggest U.S. banks reported record results from their equities divisions. JPMorgan Chase and Goldman achieving personal bests and new industry highs. We've seen the AI boom and constant repositioning by clients have driven the success of some of the biggest trading desks at some of these banks, despite concerns about war and inflation. So again, JPMorgan bagging its highest quarterly profit ever. Goldman Sachs trouncing its own Wall Street stock trading records. That stock, as we just mentioned, soaring. It's also looking to raise at least $8 billion from a high-grade bond sale. And BofA's stock traders notched a record during the second quarter, benefiting from that market volatility. Its investment bankers, too, capitalizing on some deal-making resurgence. And then I'm just going to go over to the chip makers. They give it, they take it away, they give it again. It's kind of our new favorite parlor game, watching semiconductors. The stocks today, as a whole, up about 2.5%. We had all 30 down yesterday. I think we have 26 to the upside today in the index. And then I just want to mention AMD, because some outperformance there, up about 2.5%. Some street calls there. KeyBank Capital raising their target on AMD to $725 from $530. Stock closing at $548 and change, maintaining an overweight, writing that strong AI data center demand is driving chip momentum. And so KeyBank expects AMD capacity next year to support unit growth of more than 50%. BofA also raising the firm's price target to $620 from $550 and keeping a buy rating on the share. So the good stuff continues. There's also Bloomberg Intelligence out and just kind of being pretty upbeat about a lot of names in the chip space.
Okay, those are the...
You just mentioned SK Hynix too, Carol. A big rebound there in those ADRs, up 27% at the close.
Oh, how did I miss that one?
I don't know.
That was my gift to you, Romaine.
I don't know. Tim, don't miss anything.
My gift to you are some stocks that move lower. Lucid Group, the EV maker, only sells a few thousand cars a year, as Ed Ludlow reminded us a little earlier today, down 16%. The company, as Ed and David Welch report, is working with restructuring advisors to turn around its struggling business. It's confirmed it's working with Alex Partners. The company has dismissed rumors, though, that it's considering bankruptcy as, quote, completely false, and said it has sufficient liquidity to carry its operations well into next year. Look at that chart there if you're watching on TV. You can see shares fell very sharply just before 2 o'clock today, down as much as 57% before pairing declines to close 16%.
It's like diving,
lower.
like on a reef, cliff diving.
Yeah, I mean, there are a lot
Wall
of different
diving.
images that shows.
It's evocative.
Once again, Lucid Group down more than 16%. Another company, Romain, you mentioned this, shares of software makers fell, all thanks to what we heard from IBM early this morning. IBM shares, how's this for superlative? Falling the most going back to at least 1968. Shares down about 25% throughout the day and staying there. The company came out with preliminary second quarter sales. It fell short of expectations. It said the miss is due to customers shifting their spending to chips and servers amid these AI-fueled shortages. Arvind Krishna, the CEO, said the company failed to predict that its customers would shift their spending from IBM's products to servers, storage, and memory purchases.
I love the 1968 thing, because that's basically as far back as the data go. After 1968, the Bloomberg terminal just breaks down. But I was looking it up. It's funny. I didn't realize they went public like in 1915 or something.
Is that when you were born?
Yeah. Thank you, Carol Master.
You're welcome.
But anyway, fun fact there. Tim Stenovic, who I was speaking to.
All right, let's talk a little bit, very briefly. Citi shares fell today. The company's plans to spend more on tech and AI could help whittle down headcount in the second half of the year. Shares fell by 5.3%, just one of the 5 big banks to report today. Carol mentioned some of the others. And finally, I want to end with Yum Brands. Shares fell after the Washington Post reported that federal and state health officials are investigating whether Taco Bell, it's owned by Yum Brands, whether those restaurants played a role in the recent U.S. outbreak of gastrointestinal illness caused by a parasite that contaminates fresh produce. Separately, Taco Bell removed some ingredients at select restaurants as a precaution amid an outbreak of a parasite that causes severe diarrhea. Shares of Yum Brands down a little more than 2% today.
All right, let's take a quick look at yields. We talk about the volatility in equity markets, but we continue to see that volatility in the Treasury space as well. We saw the yield on the 2-year go down about 9 basis points here on the day. A bit of buying coming back in to the short end of the curve, largely based on that relatively cool CPI report.
All right, guys, let's get to some stories on our radar. This one definitely caught Tim and my attention. Passengers falling asleep, spilling drinks, dropping food, vomiting, experiencing medical emergencies,
It's like the LIRR.
Giving birth in self-driving taxis, complicating the rollout of robo-taxi services. I love this part. People are so drunk, they're forgetting to close the door. So, like, the operators have to get to nearby gig workers to, like, close the door.
What's happening to Carol?
This is crazy.
This was written for you, Carol. I love how much you love it.
Hey.
I took a flight on Sunday, and we were getting off the plane, and I walked by a guy who was still in his seat, completely asleep. And I was thinking to myself, when are they going to, tap this guy and tell him we've arrived? Because it had been about 15 minutes. I can only imagine what's happening in these robo-taxis.
To that point, I mean, I feel like this is just public transportation problems. You have to imagine passengers across every mode of transit are falling asleep and spilling drinks and vomited.
But it's become an issue for the first responders, because people walk by and they see somebody passed out and then they call 911 or something like that, and then, the first responders come and they say, no, it's just some idiot taking a nap or,
We actually have a stat on that in the Bloomberg story. Only about 3% of such calls require transporting the passenger to a hospital. But those calls are definitely happening.
Have you been in one of these? Have you been in one of these, Carol?
Oh, are you kidding?
Are you kidding? I'm in love with Waymos.
Oh.
I am in love. Anytime I'm in a city, I try to take them as much as possible.
And how many times have you passed out drunk in one?
Romain, when you want to relax in your chauffeured SUV on the way home, what do you have your driver put on?
My drive? Well, Sade,
Bloomberg Radio.
Little Sade, little Bloomberg Radio.
Okay.
Depends. If it's the morning show.
You actually get into a Waymo. It feels like in a spa. It's so nice. The car is immaculate.
Yeah.
It's really quiet. Nobody talks to you.
Katie, do they have these in New Jersey?
The loveliest time was when my senior producer got into one of them in front of our hotel, and it couldn't figure out how to get out of the hotel driveway because there were so many cars and pedestrians, and she was basically stuck there for like 20 minutes.
There was that amazing story
She was
about
late for dinner, by the way.
Waymos getting just congregating on a specific cul-de-sac and just getting in a doom loop and going in circles.
All right, looks like we're safe for now.
Can I just say, this is a first, I think, that we've done a closing bell where we've said both vomit and diarrhea.
Hey. There's always tomorrow.
There is always tomorrow. Something to look forward to. All right, that is, I don't know where I got like all the
Carol got the giggles.
too. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Romaine and Katie finishing up there on the close on TV, and Tim and I back here on Bloomberg Business Week Daily on radio. Folks, we will see you same time, same place tomorrow.
And some breaking news crossing the Bloomberg terminal. The U.S. military is confirming that it has resumed its naval blockade of Iranian ports and the Iranian coast, effectively the Strait of Hormuz. This after we learned just about an hour ago that the U.S. military had resumed strikes for yet another day in Iran. It's having upward pressure on oil prices. We're going to have that conversation when we come back after the break, right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. Green across the screen for the most part here in the U.S. The major indices closing out the day higher, with the S&P up about 0.4%. The NASDAQ adding about 1% on the day. But there was a lot of fluctuations underneath the surface and a lot of disparities as well. Software as a sector down about 1.6%, largely based on that big drop that we saw in IBM. Bank stocks up on the day in the green, but we should point out not all of the ships rose here on the day, despite pretty much record revenues all across the board. And keep an eye on gold and the commodities space here. A tale of two cities, of course, with that inflation report this morning and late in the day now, an uptick in oil prices that maybe could actually erase that.
Well, I want to go back to the second line on that board and talk a little bit more about software, a little bit more about IBM. Falling 25% on the day, its biggest drop since 1968, of course. Also sending a chill through other software names. Lucid, as we were talking about, confirming it's working with Alex Partners. Lucid shares down 16%. And then keep an eye on SpaceX, dropping for another day here, down about 2.2%. Closing at 136. Remember, the IPO price is 135. So something to keep an eye on. But let's get to our top story this hour. And that is the U.S. saying it resumed its naval blockade of Iranian ports and coastal areas. Oil soaring in recent days, with the U.S.-Iran truce absolutely collapsing. Within the last hour, the U.S. saying that actually it launched a fresh wave of strikes on Iran, Romaine.
Rebecca Babin joins us right now, senior energy trader over at CIBC Private Wealth. And Rebecca, this gets to the idea right now of exactly sort of where the headroom is when it comes to oil prices. I know there's a lot that we don't know, but we've been here before with this back and forth between Iran and the U.S. Where you look at where we are right now in that mid-80s range, at least on Brent crude here, is this something that we live with at this price, or do traders start to maybe eye something a little bit higher?
So, Romaine, I think traders are reluctant to eye anything higher at this point, and I think there's a couple reasons for this. First, prior to the MOU being signed in mid-June, the U.S. was actively assisting ships through Hormuz during the time they had the blockade, preventing Iranian exports from getting out. There is somewhat of an assumption that that may resume as the blockade goes in place, and that we will continue to see at least some flows move through Hormuz. Now, is it going to be the full 20 million barrels of crude and product we're used to? No. But will it be a trickle like we saw when this conflict began? Likely not. So there's confidence that although we're in a very unique and very challenging situation for supply, we've come up with some creative ways to keep flows going. Saudi Arabia is still rerouting flows through the East-West pipeline, and UAE is as well. If we can keep some ships moving through, the price action indicates that we don't have that kind of explosive upside in the short term. Now, if this continues for months and not weeks, that's, I think, a very different conversation.
Well, I am curious about sort of the knock-on effects downstream, if you will. I mean, we look at the pullback that we saw in crude prices overall, crude futures, if you will, but we never really saw a commensurate drop in some of those finished products, whether it's diesel, gasoline, and everything else that goes into a jet fuel. Is there a sense here that we could continue to see more inflationary pressures on those finished products relative to whatever we see on the headline numbers?
So, Romaine, I think that's the most important question in the market right now. And if you look at the trades that have worked, it's been in the product side. The hedge fund community has been very much long diesel and gasoline versus short crude oil, which has been the trade that has worked. And why it's worked is that there's far less buffers in the refining system than there is in the crude oil production system. We don't have a lot of refining spare capacity globally. The U.S. is running flat out right now at 96% of utilization. China has some spare capacity for refining, but they're not using it because they don't want to buy crude at inflated prices. They want discounted Iranian crude. So we have a shortage of products, and we don't have a way to kind of fill in the gaps like we do with crude oil. And that's the reason why we haven't seen crack spreads come in or products come in the way that crude has. And this is very likely to persist, I think, over the next coming months, because we also have Russia no longer exporting diesel into the market. They just announced they're going to instill a ban because their refiners are being targeted by the Ukraine. So we have a compounding issue in products, is a shortage of supply. We don't have as many buffers, and that just is going to keep prices elevated much longer and for than we see for crude oil.
And Rebecca, what's the read-through into, the real economy from that? Because you could make the case that your average consumer isn't going to buy a barrel of crude oil, but certainly when it comes to some of these products, that might much more directly touch them.
Absolutely. And that's why I think you see kind of the conversations from the administration turning towards products away from crude in terms of Target saying retailers need to bring prices down more quickly, because you're right. We don't go and get a barrel of crude. We pump gasoline into our cars. Unfortunately, there just isn't a quick fix for products. We don't have as big of an SPR for products, and it's going to, gasoline prices right now on a national average is around $3.85. That very likely ticks back up into the mid fours if we don't start to see some utilization come back on in China, or we see Russia be able to kind of repair some of their refineries. So that's the conversation that I think will drive kind of the political rhetoric as we get closer to the midterms. The issue that we have is there's just a very limited levers you can pull to try to reignite refineries. It just doesn't happen overnight. That's a years long process.
And Rebecca, I do want to just quickly return to the supply conversation, because I'm taking a look at your notes and you point out that the curve still expects to return to a surplus. There was interesting reporting out today that the U.S. government is advancing talks for a pipeline to carry oil from Iraq to Syria. The idea is that you would avoid the Strait of Hormuz altogether. And, there's plenty of sort of these concepts out there. How long would it take for some of these discussions to actually bear fruit and make that supply, that surplus dynamic come back into the oil markets?
So Romaine's been asking me this question since this conflict broke out: is how quickly can various countries reroute away from Hormuz? And they're taking aggressive action. The most aggressive has been the UAE, seeing that they could potentially double their export capacity out of Fujairah by the end of 2027. Now, that feels like 100 years away, even though it's only a year and a half away, based on the headline flows we're dealing with right now. Saudi Arabia also wants to increase their exports out of Yanbu. That probably takes about a year. So we're talking about a year to a year and a half before we bear fruit there. And whether that's fast enough to prevent the next spike in prices is questionable. But it does tell me that this fear that we're experiencing is real, and that there's going to be a lot of workaround that's going to happen over coming years. But that just increases the price of the barrel, because those things come at a cost. Those aren't free, and those are passed along into the price of the barrel.
Well, it'll be fascinating to see how it all plays out. Rebecca, great to get some time with you. That is Rebecca Babin. She is a senior energy trader over at CIBC Private Wealth. Now, coming up, Morgan Stanley set to wrap up big bank earnings. We'll discuss what to expect with Erika Najarian of UBS next. This is The Close on Bloomberg. Morgan Stanley set to round out big bank earnings following today's blockbuster results from rivals. Erika Najarian, she is equity research analyst of large cap banks and consumer finance over at UBS, joins us now. Erika, great to have you with us. So the story from the 5 banks that reported today was really all about trading. You saw Wall Street traders really come out in force. Are you expecting to see more of the same from Morgan Stanley? How does this raise the stakes for them?
Yeah, so I think just to double click on your point, Katie, it was not just about trading, but it was specifically about equities trading. And to double down on that, it was very specifically about equities trading in Asia. So if we think about Morgan Stanley's historical strengths, they have been, a top player in equities for a long time now. They've had a very established sort of Asia footprint. So we expect more of the same tomorrow. Keep in mind that equities revenues, and we heard from 5 banks today, are up 70% year over year, right? And so I do think that Morgan Stanley is going to produce some pretty magnificent numbers tomorrow.
And to that point, it was all about equity trading. You saw Citi kind of punished on that point. You saw their revenue there from equities trading surge 45%, but still that wasn't enough to meet some very high expectations. And, I wonder how you're thinking about that name as we digest some of these results.
Yeah, I think that the market was, very much willing to accept that Citigroup is much more FICC heavy than equities heavy. I think what really took the stock down 5 is they essentially were returning 13% on equity for the first half of the year. So everyone thought, well, they're going to outperform their 10 to 11% ROE target for full year 26. And they said, no, we're going to stay in that range and we're going to reinvest. Pull forward some investments. And I think that given the run that the stock has had, I think some of sort of the weaker hands came out of the stock, given that implies a pretty significant step down in ROE for the second half of the year.
I am curious, Erika, with regards to the wealth management business, particularly for Morgan Stanley, but also in light of what seems to be just increasing competition, not only from its big bank peers, but pretty much all in the periphery. You have all of these new businesses, or at least expansions of businesses, and I wonder how you think they will hold up in the face of that competition.
No, I think Morgan Stanley will remain sort of leagues apart of its competition. And I'll say a couple of things. Number one, the second quarter may not look as pretty, right? So, Romaine, the big sort of watershed target that people like to look at is the pre-tax margin in wealth. And the bright line for Morgan Stanley is 30%. It's likely they'll be slightly under that because the second quarter is seasonally weaker, right? You have tax payments in terms of net new asset flows. Additionally, there's a 1-month pricing lag. So if you think about, March, April, May, that's sort of like the not so great part of the market for this year. That being said, as we look ahead, there's really a couple of things. Number one, Morgan Stanley continues to reinvest. It continues to like to disrupt itself, right, in terms of AI investments. And additionally, they bank 9 out of 10 unicorns in terms of private companies. And so while those assets from the mega IPOs are not necessarily booked yet because of lockup periods, that's on the come in the future. So I think Morgan Stanley will remain head and shoulders above peers in terms of wealth.
Erika, got to leave it there. Erika Najarian, equity research analyst over at UBS, of course, with 5 of the 6 biggest banks reporting today. All eyes tomorrow, of course, will be on Morgan Stanley and whether they keep pace with regards to what we saw today, which was pretty impressive across the board, despite some of the mixed bag with regards to equity performance.
Yeah, absolutely. The big question mark there. Will their equity traders be able to keep up? You certainly saw Citi punished for that in terms of the stock performance. And just one more to go, Romaine. One more to go, and a big focus in on that wealth business. And, well, speaking of wealth, it's not just the banks having a good time. So, too, is Sotheby's. They just released their first half results, and they were impressive. We're going to catch up with the CEO, Charles Stewart, to talk a little bit about what exactly people were buying in the first half and whether there's momentum for the second. That conversation coming up next, right here on The Close, right here on Bloomberg. All right, luxury auction house Sotheby's posting a record first half. Total sales hitting an all-time high of $4.4 billion. That's up about 60% from last year. Charles Stewart joins us right now. He is the CEO over at Sotheby's.
To talk about a great first half, and well, I guess whether that continues into the second half, their sales, not necessarily revenue, and I know you don't necessarily break out the actual earnings themselves, but were you comfortable with actually what you made on those sales?
More than comfortable. Very strong across the performance. We're a private company, so we only disclose the public top line. But yes, very strong performance throughout the business.
The conversation today a lot brighter than maybe what it was a year ago when we were, talking about downgrades and restructuring and all that. Is all that kind of behind you right now with regards to the changes that you want to make to sort of get Sotheby's back on track?
Oh, absolutely. I mean, things, for us, the markets have changed dramatically. That started about a year ago. In addition, we raised $1 billion of primary capital. That's going back about 18 months, including primarily from one of the Abu Dhabi sovereign wealth funds. It's been a game changer on our balance sheet from a capital perspective. Coupled with this incredible performance, it's been an exciting last 12 months.
And I'd love to, break down that first half figure that you have here. Where are you seeing the most strength when you think about, the areas that you're seeing demand, both, in what you're actually selling and then the type of sales that are being executed?
One of the things that's been interesting to observe is just how broad-based the results are. It is, I'd say, fine art, which is our largest kind of category overall, is where the most growth has been year over year. But if you look at it geographically, we've had bidding from 120 countries in the first half of the year. Asia returning to strong performance. The Middle East, notwithstanding conflict in the region, performing very well. And of course, the U.S. been very strong with the market performance and all the wealth formation here. And it's in fine art, but also what we call luxury, which includes everything from cars to jewelry to watches. I don't know if you're going to ask me about it, but we sold a special friend this morning.
Do you consider T-Rexes as luxury? What sort of bucket do you categorize them as?
Well, everything old is new again, as they say. And so this, in this 250 anniversary year of the United States, it seemed only appropriate to sell one of the original Americans, perhaps, 67 million years old, hailing from South Dakota. We called him Gus Rex.
Love it.
And he sold for $50.1 million this morning.
Congratulations, by the way. I don't know where Gus is going to go, but congratulations to that winner, which I assume you won't disclose to us, right?
Nope.
I do want to talk about just on the finance side before we get to some of the other interesting auctions that you've had. And this really has to do with the securitization side of the business, Sotheby's Financial, and exactly what you want that to be. Is that going to become a bigger part of the business? Do you anticipate it could be becoming even bigger than the auction house itself?
We have 4 divisions within Sotheby's. One is focused on fine art, one is focused on luxury, one is focused on financial services, which is where we did the securitization transaction. And then lastly, something we call Sotheby's Partners, which is all of our experiences and partnerships, which is a growing part of our business too. Sotheby's Financial Services, we're the largest non-bank lender in the art world. It makes a lot of sense given how much knowledge we have about the value of fine art and other high-value collectibles. So it has been a significantly growing part of the business over the last 6-7 years, dramatically so. And so the securitization, which was $900 million, was just a way to get the wholesale funding side of that business to be market-based beyond, the bank syndicate that we have, who provides the other part of that wholesale funding.
With regards to the auction house and some of the auctions you have done, I am curious just about the structure of some of the deals and the idea. Are you seeing buyers maybe ask for a little bit more on the concession side, whether it's on the top off the commission or maybe whatever I guess concierge might be involved with regards to some of those sales?
Right. We don't give any discounts per se on the commissions to buyers. We have a fixed buyer commission. That's one of the things that I think is an important principle of auctions, of being a level playing field, I guess, as you might say. And actually, our demand levels are at all-time highs. Whether that's our sell-through rate, our hammer price versus the low estimate ratio, or the number of bidders per lot, which is close to 5 bidders per lot on average right now. So all 3 of those heuristics are at or very close to all-time highs for us. So that's been the buyer demand, and what the effect that's had on our market is it's actually brought out higher quality things from sellers, who people choosing to sell in this very strong buyer demand market. So, that's really what's driven the performance.
I want to talk a little bit more about geography too, because you mentioned that you are seeing those Middle Eastern buyers still present despite what's going on over there geopolitically. That you're also seeing Asian buyers come back, which is particularly interesting because you think about the Asian market and it's been soft for quite some time there. So I was wondering if you could expand on that a little bit. When you say Asia's coming back, to what degree?
Well, Asia's been a significant percentage of our new bidders this year, and that's been a trend for a long time, in our business, just because it's such a large region, growing region, and of course you can talk about China and Greater China as a key player in that, and we're definitely seeing more bidding coming, from China, more participation. Our Hong Kong sales have been strong this year. Just as an example, we had the largest watch sale that we've ever held anywhere in Hong Kong a few months ago. So that was an encouraging sign. Those are global bidders, of course, but a lot from Asia. But it's not just Greater China. That's what's interesting, I think, especially if you include South Asia and India, Southeast Asia, whether that's, Thailand or Singapore, Malaysia, other countries in that region, Korea, Japan. I mean, it's pretty broad-based, the uptick in level of engagement right now.
So broad-based strength in Asia. Let's talk to you a little bit about, demographics, because something we talk about all the time is this incoming wealth transfer. You think about a lot of this wealth changing hands from older generations to younger investors and younger consumers of art. And I wonder, how you're approaching that at Sotheby's and what trends you're starting to see emerge among that younger subset.
Sure. Well, needless to say, it's almost a truism. It is a truism. Taste is constantly changing and evolving, and it's always going to be different a year from now from where it is today. The key is to bring to market, the right things at the right time to meet that demand and meet that taste. The great wealth transfer, the generational wealth transfer that you referred, is very, very evident in our business. We see it in the number of single owner collections that are coming to market that are well over 100, 200, 300 million dollars. These are collections that nothing of this size had ever even come to market, less than 10 years ago, really. Yeah. So we're seeing that, week in and week out. But I do think that, what younger people are looking for, the rise of categories like natural science and history, the rise of game-worn sports collectibles. We sold Brunson's game-worn Knicks jersey last week for $1 million.
I saw that.
We've got Pele's 1958, game-worn final jersey. Please,
it was a little out of my price range.
Please do.
But I am curious, though, too, about the balance between something newer like this in terms of the sports memorabilia versus traditional art. And, part of your performance, there were some mega art sales. The Lewis collection, Mnuchin, Pritzker, a couple others I'm probably forgetting, Lauder. Was in there as well. And not to be glib about it, but when you start to see those types of collections, more traditional collections come to market, is there conflict between what the younger people are looking for when it comes to, say, a watch or a sports memorabilia and things like that?
One of the interesting things is actually in the art market even, there's been a trend towards blue chip fine art, less speculative things, more established, let's say, and that pushes you further back into the past, and that may be leading you into Impressionist or the modern time period, pre-war. It may lead you into the 60s and Warhol and or into the 80s with Basquiat and others, and so. We are seeing a greater interest, a little further back with a little bit less heat in the recently produced things. That's true in art. It's also true in luxury categories, whether that's watches or cars or jewelry. Right. There's been a little bit of, whether you want to call it a flight to quality or a flight to.
Is that the idea
perception.
That those types of items have kind of stood the test of time in terms of perception?
So. I think so. And we're seeing that across age groups and across geographies and across categories. So
but how do you know when to make that switch, right? Because at some point, the stuff that's getting produced in the 2000s will become, at some point, the new.
By the way, it's a two-sided market. These may be great buying opportunities. To the extent some of those things were overheated, these things tend to go in cycles, and these can be actually very interesting entry points for collectors who have an interest but felt priced out, and you see things, recalibrate, and that's an exciting entry point. So, we'll see some of that too. It's one of the things that keeps, our business constantly interesting, and honestly, auctions, we're in business for 282 years. Auctions are a barometer of taste. They're a barometer of value and things that can be hard to value. Yeah. And it's constantly evolving.
All right, Charles, got to leave it there. Great conversation. Really appreciate you stopping by the set. That is Charles Stewart. He is the CEO of Sotheby's. Meanwhile, we do not want to bring you some breaking news, and that is OpenAI planning to release a home speaker as its first hardware product. This is according to people familiar with the matter. The product's still under development, but the idea is that it's meant to serve as a human-like AI companion that lives in your home. We'll bring you more details as we get them. This is The Close on Bloomberg. .281 Park Avenue South has a buyer. The iconic six-story building made famous by scammer Anna Delvey and featured heavily on Netflix's Owning Manhattan, selling for $81.5 million to none other than Airbnb. We're joined now by one of the key players behind the sale. Her name is Bernadette Brennan, Executive Director of Commercial over at Serhant. Bernadette, great to see you.
Thank you for having me.
So a big conversation here to have about, of course, commercial real estate and offices in New York City. But first, talk to us a little bit about this sale that we just saw for 281 at Park Avenue South. What goes into pulling something like this off, this sort of price tag?
Yeah, it was definitely a big undertaking, which we loved to commit to. We partnered with Avison Young. So Serhant and Avison Young spearheaded the brokerage and the marketing process here for our clients, RFR, who have been incredible to work for. We started by maybe what many would consider untraditional. We launched it on Netflix, Owning Manhattan. So that became a big talking point, and kind of the buzz began to just spill from there. It was a big part of Owning Manhattan and showing us marketing it and branding it and activating it. And then through the course, we would do conventions there, we would do runway shows there. We leased the building last year to Prada for Fashion Week. That was a big buzzworthy moment. As we were chatting, Fotografisco was there, so lots of attention and interest from trying to recreate something like that, bringing through like buyers of museums, nonprofits, fashion houses, lots of AI, health and wellness, and we landed our buyer.
So certainly a unique situation here when it comes to this specific property. Of course, you have the marketing coming through with the TV show as well. I can't imagine that every office building has that luxury. But, you know, you think about this sale, what does it say about, you know, the state of commercial real estate in NYC? Given that it is a unique situation, are you able to extrapolate from that?
Yeah, I mean, we have lots of sellers around Manhattan that have been really with their finger on the pulse here, waiting for this to transact. It triggers a big effect with buyers in the market, and some of the other big, you know, sales have also helped to just this resurgence of this big asset, these trophy listings that are, you know, really selling at iconic and big price points.
Well, I am curious, and you know, not to make light of it, but I mean, I think Inventing Anna probably, you know, drew some attention to it too. I don't know if necessarily buyers, certainly tourists. Every time I walk by there are people out there taking pictures in front of it. But I'm also curious too, just about Serhant as an agency, which a lot of people associate primarily with homes. And you are a commercial agent, and this is a big commercial deal. And I do wonder, is this a big push that to be a much bigger player, for Serhant to be a much bigger player in the commercial side?
Yeah, I hope so. I opened the commercial division with Ryan about 5 years ago, and we had another big building in the Plaza District for $50 million, and that was my first listing that I brought to the company. So he was like, "Are we doing commercial?" And I was like, "I think we are." And we had a plan. If we got a couple key deals under our belt, we would continue to expand and kind of, earn the right to continue. And I've transacted on over $1 billion worth of commercial real estate in the last few years. And Serhant itself has over 400 million of active commercial listings under my leadership. So we're growing.
I am curious about the difference in marketing a single family property, whether it's a condo or an actual house, relative to a commercial building, the types of people that you're going to have to deal with, and more importantly, I guess, the different types of needs. So kind of draw that line between, I guess, what we would traditionally think of luxury residential real estate and now luxury commercial.
I would say the biggest difference really is that in a home, it's more emotional. And in a commercial property, even if someone is attached to it and it's emotional, at the end of the day, it has to make fiscal sense and business sense. So there has to be an underwriting process, and usually there has to be an end user like Airbnb or something that's going to kind of tie in why this purchase, is attainable and makes sense. So I think that's like one of the biggest things is dealing with people on a less emotional trigger space.
Maybe a little bit more transactional. Like you say, it has to make financial sense. You know, when you talk about commercial real estate in the context of a city such as New York, a lot of people, their minds go to office. But what are you seeing outside of office when you think about different types of commercial properties?
Yeah, it's super interesting. I think there's a big move right now in the experiential space and the pop-ups. A lot of our big listings, like we just listed the John Lennon townhouse at 496 Broome. We're activating that for fashion houses, AI concepts. Some car companies have come in there, just kind of creating this more one-on-one experience with a lot of tenants and buyers and viewers and retailers. Seeing a lot of that. We also just listed 11 Franklin, which is a big development site. We're in the process of upzoning that right now. So we've also begun leasing that to a really big, which we can't announce yet, but a publicly traded company in the entertainment space. So there's lots of alternative uses coming into these traditional commercial spaces that you may not actually think of that are actually starting to really take off right now.
And does like the Serhant playbook with regards to the television show and that, does that help on the commercial side the way it does for residential?
I think so.
Yeah.
You know, it can't hurt. You know, when I do my pitches, I tell people that, you know, our viewership is 14 million. We're in 26 countries. We could potentially put you on a reality show. It becomes easier for people to want that branding and that visibility. So, yeah, I think it all kind of comes into play. I've adopted Ryan's marketing for residential with our branding for commercial, and it's just been this really interesting, beautiful process that we've been building on.
All right, well, it's really great to have you here.
Thank you so much.
Bernadette Brennan, Executive Director of Commercial over at Serhant, just selling that 281 Park Avenue South building here in Manhattan. When we come back, we're going to take a look at the power grid and the latest auction and the uptick that we've seen in those prices because of the boom in data centers. That conversation coming up after the break, right here on Bloomberg. All right, some breaking news just a little while ago. This involving the biggest U.S. grid operator, PJM Interconnection, falling short of a key power supply goal amid all of the strains from the AI data center build-out. Will Wade joins us right now, who covers energy for us here at Bloomberg. And just to put this in context, they have these auctions. So this latest one is for basically the 2028 delivery here going forward. Those prices, effectively wholesale prices more or less, have been going up because of everything that's been going on.
Because everybody needs electricity.
They've capped that.
Yes.
So they had another auction, and it was capped at what?
$325 a megawatt day. That's the technical thing.
Without that cap, what would it have been?
It would have been like more than $500.
More than $500. And this has been a trend that we've seen for basically the last three auctions.
Yeah, the last three
going
auctions.
Up.
Yeah, so they didn't meet their target. They didn't procure enough electricity to meet all the demand they think they're going to need.
Did they say what they're going to do in order to do that? Can they do it?
Well, they're working on different plans. There's a meeting next week. FERC, the regulator, is having a meeting to sort of figure out how to adjust the rules here. So what those numbers are telling us is that the regulators are saying, we're not going to let you charge more than $325, and the people that deliver power that want to build more power plants say we need $500 to make it worth our time.
So give us a context in terms of the stakes here, because the grid that we're specifically talking about, as I understand it, is home to Virginia's data center alley. So we're talking about a key corridor here.
Well, it's not just data center alley, but yeah, that's there. That's the biggest cluster of data centers in the world, you know, sucking up tons of power, but it stretches from Chicago to Washington. It's 13 states. It's like 1 in 5 people in America get power on PJM.
And so, you know, as you said, you know, there's a meeting later this week, I believe. I mean, I guess my big question is, what happens now? I mean, what are we expecting to happen at that meeting next week? How does this get resolved, given that it seems like there's a lot of daylight here?
Well, all right, so the thing to know is, like, we're not in imminent danger of a blackout. We're not going to run out of electricity, probably. What PJM told us today is they are now at, quote, slightly elevated risk. So the grid needs some help, but it's not about to fall apart. So this is about lining up enough electricity for what people think we will need in the next coming years.
Well, we'll really appreciate your reporting on this issue. That is Bloomberg's Will Wade, who covers energy for us.
All right, we're going to set you up for what to watch over the next 24 hours. The markets, of course, continue to have an eye on earnings. Katie Greifeld, we got 5 big banks this morning. We get another big one tomorrow.
One more to go. Morgan Stanley rounds it out there when it comes to the big banks. We'll also hear from BNY Mellon, also going to hear from J&J and ASML as well. And then aftermarket, and ASML could actually be interesting too, of course, with all the focus on data centers and the chip supply build out. We're going to hear from United Airlines as well after a market. We heard from Delta, what was it, on Friday, and they were pretty bullish about how things are shaping up. We'll see if United can actually match that. Absolutely. And then coming off of that CPI print that we got this morning, 8:30 a.m. tomorrow, we're going to get an update on U.S. PPI. We'll see if that matches that cooler than expected tone that we got in the CPI print this morning. And Kevin Warsh, the Fed chair, is back on the Hill for round 2 of his testimony, this time before the Senate Banking Committee. And we're going to get the Fed beige book at 2 p.m. Anecdotal, Katie Greifeld, but sometimes it does provide some color, if you will. Sometimes. Hopefully something a little bit deeper than beige into the state of the consumer and everything going on. I feel like when you put beige in the name, it says don't look here. But here on The Close, we're going to take a look and comb through it for you. We'll have any news out of that right here on The Close. Meanwhile, for all your political coverage, and there is a lot going on there, stick around. Balance of Power is up next at the top of the hour right here on Bloomberg.